Welcome back to Lim's Cryptoverse. Today, I want to talk to you about what's going on with the Fed. Everyone's talking about the big Federal Reserve FOMC, Federal Open Market Committee meeting coming out. And by the time you see this video, the decision's going to already be made. So basically, everyone is expecting the Fed to get more dovish. Now, I'm expecting the same too. Over the last year, the Fed has raised rates, believe it or not, 8 times. Is that eight? 8 times. And I was able to predict every single one of those accurately. So how could I do that? Well, I have to be honest with you. I cheated a little. I look at what's called the CME Fed Tracker. It's a probability tracker. Basically, it shows you what the betting markets are basically betting on in terms of the probability of the Fed funds rate, being at what level on what day, and that always tips me off on what the Fed's going to do. So right now, they're expecting a nearly 100% chance. Investors are expecting 100% chance. Actually, it's 99% chance that the Fed eases off its gas pedal. Actually, I should say brakes. That the Fed's going to raise rates only 25 basis points. If we recall, the Fed raised rates 8 times, and first they started off too slowly. I don't know why they did that. I think they should have front-loaded it even more. But they raised rates in the beginning by something like 25 basis points, and I think it was 50. But basically, after that, it was 75, 75, 75. So 4 times raising rates 75 basis points. And then if you remember the last few speeches by Jerome Powell, JayPo said that he wants to take a wait-and-see approach. So that's why investors are expecting the Fed to ease off the brakes. And if you recall, the Fed already started easing off the brakes because they lowered the Fed funds rate increase from 75 basis points to 50 basis points. And why? And if you look at the CPI, the Consumer Price Index, and of course there's a million ways of measuring CPI. And we all know that the Fed loves the PCE, the Personal Consumers Expenditures. But the point is that all data, all types of CPI data, I shouldn't say CPI data, inflation data, whether it's the PCE, the core PCE, the PPI, the core PPI, whatever it is, it's all coming down. So the last CPI data, inflation data that came out was a pretty good number. It was 6.5%. If you don't know anything and you just looked at that number, it would look bad, but you have to recall that it was 9.1% in June. That was a max rate, 9.1%, and it's been steadily decreasing. Now, if you look at something I like to look at, which is true inflation, like what's the inflation rate for people like you and me? And there's a website actually called True Inflation. And that website had inflation, believe it or not, peaking at 12%, 12.1% way back in March of 2022. And that rate has actually come down even faster. So it went from 12% way down to the recent data point of 5.5%. So that's a really quick decline. So this is why the Fed has the ability to stop slamming the brakes on the Fed fund rate increases. So I'm pretty confident they're going to raise rates only by 25 basis points. So what would I like? I would like them to raise rates by 50 basis points, but I think it's going to be tough for them to do that. So why do I think the Fed needs to be hawkish? Here's the problem. Everyone's talking about higher rates, how it's hurting the economy, and that's true, but that's a lagged effect. So everyone's talking about tight liquidity, but believe it or not, I think we're in the loosest liquidity, the most easy liquidity we've had in nearly a year. I'm going to give you some examples. Number one, stock prices are rising. Capital markets are strong. And we all know how the stock market's doing lately. Even the Russell 2000 is doing well, and small caps are doing well. Secondly, tech stocks are doing well. Even Cathie Wood stocks are doing well. ARK Innovation and all those other versions of ARK. Bitcoin's doing well. Crypto's doing well. Solana, which was left nearly for dead after FTX and Alameda went bankrupt, Solana has gone up like crazy. Aptos, which is another of Sam Bankman-Fried's favorite coins, that coin has gone up 400% in 1 month. Yes, 400%. Trying to think of some other reasons. Credit spreads, investment grade spreads, high yield spreads. These have all gone down. They've gotten even tighter. This is not supposed to happen when the Fed is so hawkish and when the Fed raises rates. The opposite is supposed to happen. Default rates are supposed to go up. Credit spreads, premiums are supposed to go up. Stock market equity risk premiums are supposed to go up. This is not happening. And one very important point I want to tell you, and that's the dollar. The dollar is supposed to be going up when the Fed's raising rates. Instead, the dollar has been declining rapidly. I'm trying to remember the time period. I think it's over a month, but over the last month or two, the dollar's been going down fast. And even Europe is doing well. This is going to be hard to believe. I forecast that Europe would be in a recession. I made a big mistake there. I mentioned to you a few months ago, my biggest mistake was timing. Another mistake I would say is that I expected Europe to be in recession, but natural gas prices and energy prices have gone down dramatically. There's been a big reaction to what's going on with Russia's threat of cutting off gas, and America has come to the aid, I suppose, of Europe, with LNG shipments and all that. So basically, to make the long story short, the most recent reading that came out for the Eurozone shows that the Eurozone economy is actually stronger than China and the United States. That is so hard to believe. I expected negative growth for the Eurozone, and in fact, the Eurozone growth is actually 3.5% on an annualized basis. So it's been unbelievable. So again, just to wrap things up, I think the Fed's going to raise rates 25 basis points, but what may scare the market, so my prediction this time is not really for the Fed funds rate. My prediction is that the Fed, JayPo, he's going to be extremely hawkish. Yes, he's going to say he's going to wait to see how the economy does after he's raised rates like 9 times, but he's also going to remain hawkish. He has to be hawkish because the liquidity is too loose, the stock market is too strong, and one thing I didn't mention to you is that the unemployment rate is way, way too low. And remember, this is what's going to keep, I should say, inflation too high. Wages are sticky, especially in the services economy. So the Fed cannot get rid of inflation on a permanent basis unless it puts a hole, it strangles the labor market. I hate to say that. We don't want to see people losing their jobs, but the Fed is left with no choice but to get the labor market going down. And we all hear the news about the tech layoffs, and there are thousands of layoffs in Silicon Valley. But you know what? What people don't see, what you see is the headline news, tech layoffs, massive tech layoffs. But what you're not seeing is that the tech economy is a very small portion of the total labor economy. That's the problem. The problem is, even if you get thousands and thousands of layoffs in the tech economy, that is not going to make the unemployment rate budge enough to satisfy JayPo. Just think about it. If you get thousands of layoffs, let's call it 50,000 in tech, the unemployment rate won't even reach 4%. We need to go much higher than 4%. And the only way for that to happen is if there's broad weakness in the economy, not just from the tech economy, which is kind of like a bubble. in the economy that touches you and me, and this includes government jobs too. We need to see layoffs in the government sector, which is huge. So that's all, folks. So what I'm looking for again is a 25 basis point increase in the Fed funds rate. And the Fed's going to be, the JayPo, I should say, is going to be much more hawkish in his comments to the press. And I think this could finally affect the stock market, and maybe stocks will go down after the Fed gives these hawkish comments. Well, thank you all for listening at Lem's Cryptoverse, and don't forget to like us and subscribe to us. And if you do that, this is how we can continue these videos. Thank you. Bye-bye.